Art, we're looking at an S&P gapping down below 2,800 here. And we've seen the last 3 days, we come up higher, we close lower. Right. Where's the weakness? How much more downside for the equity market?
Well, the weakness really is in semiconductors and technology in general, and that's led this downdraft. And it feels like this has been happening for a long time. This is 5 weeks, we're at 5% off all-time highs. So it's pretty orderly, 1% a week drawdown in a situation that completely reversed itself 5 weeks ago. So we were at the doorstep of having a deal done with China, or at least that was the impression we got. We're miles away from that now, and we don't have any real new information until the end of June. So this is what the market's trying to do: just recalibrate to how much risk we should be pricing in. We're probably at appropriate levels. We're probably getting to the point where we have to say, okay, this is enough until we get something new.
Well, does that appropriate level square with what's going on in the bond market? Because the bond market has been a little bit more urgent, I guess it's fair to say, than the equities markets.
Yeah, and the interesting thing about the bond market is it's been that massive flight to safety, right? So when you think about where can I go to keep my money safe in a large liquid market, and unfortunately that's U.S. 10-year, and then that inflow of cash is going to draw down the yield on the 10-year, and that's where we are. And there's nowhere else in the world you can go. Interestingly, when you talk about the Chinese perhaps selling the U.S. Treasuries, where else are they going to go? And unfortunately, if that was one of their threats, they're certainly not doing it right now. If you look at the bond data,
they'd have to sell it to defend the yuan. So there's kind of like this. There's a picture there too. We're going to dive more deeply into bonds in just a moment. But staying on that theme, if you come inside the Bloomberg here, this is the function GRR Go. So it's taking a look at the sector performance within the S&P yesterday. Consumer staples and utilities, the worst performer. Explain that one to me. The bond sensitivity. Yeah, well, this is a trade that got so crowded that it doesn't take very much for this to be a counterintuitive move. But a day like yesterday, you would have thought you want to recrowd into it.
Yeah, absolutely, and that's exactly what happened yesterday. It didn't. It's very much like saying semiconductors got crushed yesterday. The index was down 1%. Many of the names are down 3%. Advanced micro devices was up 10%. So there's going to be those days where things happen that just don't make any sense. Over the course of the last 5 weeks, those three defensive dividend darlings have actually outperformed the broader market. Yesterday just was not one of those days.